I think both of you gentlemen have made some comments about that manufacturing report yesterday and its effects on the markets. It is October 2nd. October is thought of as a bad month, but not necessarily always a bad month. And September was pretty quiet, right, Ryan? What does that mean for October?
Well, that's right, Joe. First off, good morning, and thanks for having me back. But you have to go back in history. September was one of the least volatile Septembers we've seen in a long time for the S&P 500. What's it mean for October? Well, look at yesterday. Good volatility. We think there's going to be a lot more volatility. October historically has had more 1% moves, either up or down, than any other month. The good news, though, Joe, the last 20 years, October is actually the third strongest month. So, there's all these different factors. And then, hey, we're in the fourth quarter, right? The strongest quarter of the year. Historically, when you're up 15% for the year, like we are now, the fourth quarter actually does a little bit better. But you tend to have more volatility in the month of October. And, Joe, like any Cincinnati Reds fan says about now, tomorrow might be a brighter day. You look at that ISM number yesterday. Yes, it was very poor. But the global ISM numbers higher the last 2 months. Production's been higher. Factory orders have been pretty good. Consumption's been really strong. Housing data has been good. So we just don't see with the impending recession that's going to start tomorrow, like so many people think. Yeah. There's still some pockets of good things, and the consumer makes up almost 2/3 of GDP. Consumer's still in good shape, in our opinion.
The Reds passed the baton off to the Bengals now. The 0-4.
Yeah. Oh boy, let's not go there, Joe.
No. So. James, I don't know. See, for me, October, I just think of it, I don't know, it's there in 1987. It's just a cruel month. And you got yesterday, how's that grab you? And then today we're down another 200. So it just seems like it's not starting off great.
Well, I think we're looking for a catalyst right now, and the negative inertia of manufacturing globally has now seemed to have spilled over into the U.S. But as your guest mentioned, the consumer really still is buoying the global economy, the U.S. consumer. We'll have employment data on Friday. We had a reasonably soft print in September, probably to be expected given where we are in the labor markets right now. But I agree with your guest. We're not tipping into recession here, given the relative strength of the consumer and how much that dominates the U.S. economy. But it is a little troubling for us that confidence, it seems, at the corporate level is waning. That may be trade, that may be Fed, that may be global slowdown. But if we don't have a reacceleration of CapEx and business confidence picking back up, our real GDP is going to fall well below that 2% level because we have demographics, we have productivity to move GDP, and if we're not spending money and reinvesting in business, that's going to be a problem for the real economy going forward.
So I think we're right on the cusp of earnings season, aren't we? Have I got that right, Santoli?
Yeah.
Because it's September was
next week. We'll start getting them.
Calendar year.
That's it.
Third quarter ended in
3 month
September.
steps, yeah.
Do either of you gentlemen think that's going to actually bolster the bulls, or we're going to see more of the same in the fourth quarter? Still tough comps from last year, isn't it, Ryan?
No, it is still tough comps, but Joe, historically what happens, right? The lowered expectations, we do beat that bar. Third quarter earnings might come in negative, maybe get the talk of an earnings recession again, but the fourth quarter earnings are supposed to accelerate. And, look at next year, 2020, emerging market earnings next year are supposed to be about 13%. Now, that's a little high. We think it'll be a little lower. U.S. earnings, 10% next year, might be a little bit lower. But again, globally, even Europe, as big a mess as Europe is, their earnings are supposed to be 9% next year. And all those numbers will probably come down a little bit. We get it. But hey, that's a global acceleration potentially next year. And that's really the case that we see. We understand all the concerns about manufacturing. We've seen manufacturing in the United States go beneath 50 multiple times, during this expansion. And in 1995, 1998, there have been periods where you can have that. But again, you can have that acceleration later. It's like the guest before me just mentioned. Confidence comes back, and it's all about U.S.-China trade. We really do think sometime in the first or second quarter we get some type of resolution, because let's be honest, it's an election year, and you need that good news heading into the election. So let's not ignore that.
So, Ryan, that's James. James, that's Ryan. Just so you guys, you can say, right, both of you guys are with your other guests. You have no idea who you're on with. Meet. Yeah, look over at each other. Yeah, you're both James Camp, Ryan Detrick. Okay, you guys? You got it? You got it, James?
Yeah, right. And I do, Joe. And I would make the comment about the earnings recession. We saw this in 2016. Where we had the 10-year at 150. We saw in 2013 with the Euro crisis. The issue there was we had massive policy responses at the ready to pull us out of those earnings recessions. I think policy responses on the fiscal side are actually a net negative right now because of trade. And I think central banks are frankly, diminishing marginal returns, if not worse, at this point. So I'm a little more sanguine about the outlook for 2020. I'm not a recession forecast right now, but I do think it's going to be more difficult in the capital markets. We've had an extraordinary year, both on the debt side and on the equity side, and some more modest returns are probably in the cards going forward.
All right, so just in summary, you're in Florida, James. You're in South Carolina. Yeah, you guys can't really do lunch, probably. But
we're in the Tampa St. We're in the Tampa St. Pete area, and we're still playing baseball tonight. So
yeah, both places I'd kind of.
You do realize they're sitting in a closet staring into a hole in the wall, essentially. They don't have a monitor like we do. They don't get to see these things.
That's why I thought it'd be nice to introduce them
to
each
get
other.
to know each other.
So bottom line, James, we got low interest rates means valuations maybe aren't that stretched. You got maybe earnings are going to be okay. So, I mean, are you expecting some type of break in the markets, or you think you'd add to positions here, Dave?
Well, Joe, I think the question becomes, which market is right? I mean, the bond market has voted resoundingly that no inflation, global growth is rolling over. The stock market still seems to be moving higher. And for our products that are asset allocation products and income agnostic products, we're frankly going to sit out some of the fourth quarter in T-bills right now because we're yielding 2% to wait and see which way markets break.
Ryan, I know you think we should buy dips, basically, right?
No, we do, Joe. And adding to what James said, last year was the first year since 1969 that stocks and bonds were lower. So it makes sense we're having more acceleration now, maybe into next year with both assets higher again.